Today on Mark Talks Finance, we're going to cover my 3 Canadian ETF picks for the month of February. So yes, these ETFs are only going to be available on the TSX, and also these picks are monthly dividend payers, so you get a nice treat there as well. And I'm going to sprinkle a sleeper pick in there too. So I'm not just going to give you ticker symbols and call it a day. We're going to look into these ETFs and talk about why these ETFs are a good idea to consider at this point in time. So let's take a look at the list. But before we do, please drop a like down below for the YouTube algorithm, as it really helps out the channel and also lets me know what sort of videos you guys like to see. So with that said, let's get right into it with our first ETF, which we'll take a look at. And this is the iShares S&P TSX Canadian Dividend Aristocrats Index ETF, ticker symbol CDZ. Now CDZ is an offering by BlackRock, and this fund aims to provide investors with a steady monthly income through dividend payments. And best of all, the CDZ fund achieves this objective by investing in high-quality stocks from the Canadian markets. Introduced in 2006, this fund boasts assets under management of over $1 billion with a dividend yield of 3.17% distributed monthly. Now, it does have an expense ratio of 0.66%, which is a bit on the high side, meaning that for every $10,000 invested, you will pay a fee of $66. Now, taking a look at the sector composition, we see that although this is mostly weighted on financials, with the financial sector coming in at 25% allocation, followed by energy at 13.3% and real estate at 12.3%, with utilities at 10.8%. Now, even with this, it's not as heavy as the other ETFs on the financial sector, which in turn offers increased protection and a strong yield, but you do sacrifice some appreciation because of how diversified this is across these other sectors. Now, if you look at the fund breakdown by holding, we see a pretty even weighting throughout, with Montreal investment firm Fiera Capital taking the top spot. This is followed by Slate Grocery, which is a REIT, and then the next 4 spots consist of the biggest energy and utility companies in Canada: Keyera Corp, Enbridge, Pembina Pipeline, and TC Energy. Now, rounding out the top 10 are First National, Capital Power, Manulife, and SmartCentre REIT. Next, let's take a look at the performance of this ETF. As we can see over the past year, this ETF has given returns of 26.14%, with a 3-year annual return of 12.95%, and a 5- and 10-year annual return of 8.37% and 8.18% respectively. Now, this ETF is focused on income, which is why you don't see a lot of capital appreciation here. But for those that are happy with an 8 to 10% annual return paid monthly, you can't really do much better than this. Now, if we do a quick simulation with $10,000 invested and $5,000 annual contribution over 20 years, at a 10% return, we project a return of $382,287, which is not a bad return, because you are keeping on pace with the S&P 500 and in some cases beating it, while getting a nice tidy return at the end of 20 years. Now, the next ETF we'll take a look at is the iShares Core MSCI Canadian Quality Dividend Index ETF, ticker symbol XDIV. Now, XDIV is a fund offered by BlackRock that was initiated in 2017. Now, this ETF tracks the MSCI Canada High Dividend Yield Index, which focuses on well-established companies with above-average dividend yields and great track records of increasing your dividend over the long term. Now, looking at the stats at a glance, this ETF offers a dividend yield of 4.11% at the time of this recording, and a low expense ratio of 0.11%, which is one of the lowest among Canadian ETFs. Another impressive attribute of XDIV is that it's a monthly payer, so if you're someone that's focused on income, this ETF provides that as well. Now, the top holdings in this ETF include some familiar names like TD Bank, Bank of Nova Scotia, RBC, CIBC, TC Energy, Nutrien, Manulife Financial, Sun Life Financial, Fortis, and Power Corporation of Canada. As you can see, the top 4 spots are occupied by the big banks, with each coming in at just under a 10% weighting. Together, you also notice that these top companies account for over 80% of the ETF. So this is heavily weighted towards financials, with the financial sector making up approximately 60% of the fund. This is followed by utilities at 11%, and then communications at 10%. So with this heavy weighting towards financials and utilities, what makes this ETF a good pick, especially now? Well, financials, utilities, and telecom make up most of the top companies in Canada, which is a good thing to consider, especially at the time of this recording. We're entering into a period where multiple rate hikes are expected over the coming months, and when this happens, the industry that stands to benefit the most is the banking industry. So in addition to the dividend, we'll also be able to participate, very well I might add, in the anticipated run-up as a result of the interest rate hike. Secondly, the financial, utility, and telecom sectors have proven to be very defensive, meaning that even in a market downturn, there's less danger of a dividend cut. Also, if we look at the beta, which measures the volatility of a security compared to the S&P, anything below 1 is not as volatile and anything above 1 is volatile. So we see that this ETF comes in at a beta of 0.59, meaning that it won't be as sensitive to the general market movements. Now the downside here is that there are only 23 total holdings in this ETF, and even though that's usually enough for a diversified portfolio, the fact is that this is heavily weighted towards financials, and this might deter some who are looking for a combination of growth and dividends. So if the financial sector takes a hit, you will not see any capital appreciation. Now let's take a look at the performance of this ETF over the last few years. We can see that in the last year there was a return of 35% and a 3-year average annual return of 14%. There's no 5-year or 10-year data available at this time because the fund hasn't been around that long, but these are very encouraging numbers. And given the holding of the fund and the current market conditions, I anticipate that it will perform very well in 2022. Now, doing a quick simulation here, we can see that $10,000 invested over a 20-year period with 5,000 annual contributions and an average return of 14% will give a return of $656,277, which is very good. So it's definitely an ETF to consider if you're looking for a good combination of growth and capital appreciation, as it does yield a higher return than the previous ETF that we looked at. Now, before we go to the third pick, I want to use this time to introduce my sleeper ETF pick for February. Now, I'll preface this by saying that my reason for including this particular ETF is in line with what I said previously, current market conditions, and the fact that this ETF has been beaten down quite a bit as a result, which is a great time to take advantage of the discounted price. And the sleeper ETF is the CI Tech Giants Cover Call ETF, ticker symbol TXF. Now, TXF invests in the 25 largest technology companies measured by market cap listed on a North American stock exchange, and it employs a cover call strategy, which sells option premiums on the underlying stocks for additional income. This fund has been around since 2011 and has an expense ratio of 0.65%, which means that you pay $65 for every $10,000 invested. However, this ETF also has the highest dividend yield on today's list, coming in at a whopping 10.72% distributed quarterly. Now, this is all due to the cover call strategy that helps supercharge the income. Now, usually this would be at the expense of capital appreciation, but if we look at a performance history, we see something very interesting. The 1-year performance yielded a 27% return. The 3-year return was 26.85%. There's no 5-year data yet, but since inception, it has easily cleared 20% annual returns. Holdings have more or less equal weighting with some of the biggest names in tech. I'm not going to list them all, but I will put a snapshot of the list up on the screen here. And as you can see, the list consists of the usual suspects. So no surprises here. Now, one thing to note is that this is a quarterly dividend payer as opposed to monthly. So that's one thing to be aware of. The other thing is that this is a bit of a riskier play given how beaten down the tech sector is right now. But that is also an opportunity for greater upside since this ETF is currently trading at a discount right now due to fears of rising interest rates. This is a pick to take a serious look at due to the combination of high growth and high dividend. We're running a simulator on this one with the same parameters, $10,000 initial investment with $5,000 contributed annually over the next 20 years at a 21% annual rate of return. We get $1,727,680. I don't think I need to say anything else. So let's just move along. I ain't saying nothing else about this one. You've seen the numbers. I'm just going to let that one go. All right, so moving along. The next ETF we're going to take a look at is the Vanguard FTSE Canadian High Dividend Yield Index ETF, ticker symbol VDY. Now, VDY was created by Vanguard in 2012, and this ETF aims to track the performance of the broad Canadian equity index that measures the investment return of common stocks of Canadian companies that are characterized by high dividend yield. Simply put, it invests in great dividend-paying companies across all industries. Now, looking at the stats at a glance, we see that this ETF boasts assets under management of $1.5 billion and a dividend yield of 3.58% with a low MER of 0.21%, which means that for every $10,000 invested, you will pay $21. Now, keep in mind that these fees are automatically deducted in the background, so you won't be charged anything extra or need to take any additional action. This is also another monthly payer for stable dividends. Now, if we look at a sector breakdown, we can see that this is heavily weighted on financials, energy, and telecom, with financials accounting for 58.8% weighting, energy at 21.9%, and telecom at 8.6%. After that, you have utilities at 6%. Now, if we look further into the breakdown, we see that the top holdings are RBC, TD Bank, and Bank of Nova Scotia at 14%, 13%, and 8% respectively, followed by Enbridge at 7.3%, and BMO at 6.5%. I'll put the rest of the top 10 up here, but as you can see, it's banks, telecom, and energy. Again, this is not a bad thing, as these sectors are the backbone of the Canadian economy. Some might not like the heavy allocation in the banking sector, but you can offset this with another broad market ETF, so this is not really an issue. Now, if you take a look at the performance numbers since 2012, we have a little bit more data to look at from a historical perspective. We can see that last year, this ETF yielded a total return of 4.26%, which is a 3-year average return of 16.6%, and a 5-year average of 10.8%. Now, since this fund was established in 2012, there's currently no 10-year data available. So if we assume a 12% conservative average return going forward with the same parameters as before, which is $10,000 initial investment with an annual return of $5,000 over 20 years, we end up with a projected return of $499,956, which is just under $500K, which is very, very good. Now, I hope you enjoyed these 3 dividend picks and the sleeper pick that I included. Leave a like down below if you did. I believe that any of these picks can be core holdings in your portfolio, and you don't have to pick them all. Just pick the ones that you think are a best fit to your investment strategy. Now, if you have any thoughts on these picks, feel free to leave a comment down as well. And with that said, thanks for watching. I'll see you in the next video.